Hello everyone. This video is a comprehensive guide on the trading strategy called Algorithm AB. Today, we'll go through all the basic concepts of this method and cover the following points: top-down analysis, time frames and variables, volume confirmation rule, shifted POI rule. But before we start, please give this video a like and leave a comment if you're interested in this topic. This will help me understand if I should continue making videos on this subject. The first item on our list is top-down analysis. Let's start with defining this term. Top-down analysis is a method based on sequential analysis of charts, starting from the higher time frame and ending with the lower one. The goal is to gather variables that we will then synchronize to determine the most likely price direction. In other words, to determine our bias or narrative, we need to collect information from all time frames. How will this help us? The logic is simple and forms the basis of our strategy. First, we must understand that each time frame has its own reaction time to a specific zone of interest or problem area. The larger the time frame, the slower this reaction. If we illustrate this principle schematically, we'll see that the larger the distance between the time frames on which the position is entered and those that define our zone of interest, the lower the probability of a positive outcome. This is why some patterns, like a reversal from 1 hour to 5 minutes, are ineffective. The second item on our list is the time frames and variables we use in our strategy. As for time frames, it's straightforward. According to intraday trading, we use the most popular and accessible time frames that have always been used by the most successful traders. These are 1 week, 1 day, 4 hours, 1 hour, 15 minutes, 5 minutes, and very rarely, 2 minutes. Naturally, the larger the time frame, the more important it is to us, as it provides stronger variables. What are variables? If you've watched previous videos, you should already be familiar with the concepts of inefficiencies and liquidity zones. These are our variables, and there are 4 most important ones: order block, rejection block, fair value gap, and fractal low and high. That's all we need. Now, if we summarize everything we've discussed so far and combine it into one concept, we'll get this pyramid, where each time frame has its place in the system, and when we analyze the market, we always follow this order. Thus, each time frame sequentially provides a variable that we then synchronize with other variables to build our narrative and trading plan for the day. Now that we understand what top-down analysis is, what time frames we use, and what variables are, we can move directly to Algorithm AB. One of the most important rules in this algorithm, which is used everywhere, is volume confirmation. This rule involves validating a certain zone of interest by receiving confirmation that volume has entered the market on a smaller time frame. The rule is as follows: X time frame zone X minus 1 time frame volume confirmation. As a result, we get a validated zone. And again, there's nothing unusual here because the tools we use for volume confirmation are our volume tools. To understand this better, let's consider the following example. The price reaches a certain zone of interest located on the X time frame. In our case, let's say it's a 4-hour fractal low. To consider that this zone is buying volume to push the price up, we need to get volume confirmation on the X minus 1 time frame. In our case, we get the formation of a fair value gap zone on the 1-hour time frame. Now, this FVG becomes our new POI zone, after which the price tests this zone and moves higher. Here arises the second very important rule in this whole strategy, called shifted POI. The essence is that if we get volume confirmation from a certain zone on the X minus 1 time frame, it means that buying or selling volume has already entered the market. Thus, after testing this zone, the price is ready to continue its movement. This is the entire logic behind volume confirmation and shifted POI. The formula for this rule looks like this: X time frame zone, POI, X minus 1 time frame volume confirmation result, X minus 1 time frame equals new X time frame, shifted POI. By performing this process of volume confirmation each time, we form a certain chain of actions. And finally, we need to mention the concept of A and B. Why is it called that, and what is the logic behind it? First of all, I want to note that the basis of all movements in the market is founded on the basic postulates of the smart money concept, which are as follows. from liquidity to inefficiency and from inefficiency to liquidity. And the second is from internal liquidity to external liquidity and from external liquidity to internal liquidity. If we display this schematically, we get 2 points. The first is point A, which can be either a liquidity or an inefficiency zone, and the second is point B, which can also be either a liquidity or an inefficiency zone. The main requirement for us as traders is to find a method to monetize this logic. This is why the AB algorithm was created. The basic algorithm is called the classic chain AB, and it consists of 5 variables. The first thing we need to get is the global narrative, or in other words, the background for our positions. This can be any of the tools we use: order block, rejection block, fair value gap, or fractal point. Initially, this variable is on the X time frame. Considering we are intraday traders, most often this will be the 1-day time frame. Next, we need to get the second variable, which is volume confirmation on the X-1 time frame through the use of order block, rejection block, or fair value gap. Once we get this variable on X-1, which is 4 hours, it becomes our new zone of interest, X. We mark this as point A. Thus, the variable on the 1-day time frame becomes X plus 1. To repeat, we have an area of interest on the 1-day time frame, then we get volume confirmation on the 4-hour time frame, and the 4-hour time frame becomes our new zone of interest, that is point A, because it confirmed volume in the market. This is the rule for X-1 volume confirmation and shifted POI. At this point, we already have a chain formed from 2 variables that increase the probability of our position. The third variable will be located on the X-1, in our case, the 1-hour time frame. This variable should have a trigger function that provides liquidity in the market. This can be either a fractal point or a fair value gap inside or near the POI. The fourth variable completes the chain and allows us to enter a position. We need to get volume confirmation on X-2, which is the 15-minute time frame after the price has tested the FVG or made a liquidity raid at the fractal point. But here is a very important detail. Volume confirmation on X-2 can be either an order block or a fair value gap. We do not use the rejection block on smaller time frames because it forms quite often and can lead to a stop loss. And the last variable, which is very important in this entire system, is the target, which is our point B. It is located on the same X time frame as our POI, which is 4 hours. Usually, our target is the nearest fair value gap zone or fractal point. Thus, entry into a position is made if the target is favorable for our risk-reward ratio. This was the classic chain AB. It may not be clear at the moment, so let's look at an example on a real chart. In the context of the weekly traded volume, which is a very important variable for the long-term market outlook, the price on the daily chart forms a rejection block, indicating that selling volume has entered the market. Let's mark this as X plus 1, which will serve as the background for our position. Following this, over the subsequent days, the price tests an equivalent zone on the daily chart in the form of an FVG, from which buying volume enters, leading to a test of our rejection block. Now, within our X plus 1 zone, we need to obtain volume confirmation on the X time frame. We subsequently get this in the form of a rejection block, which is our point of interest, and we mark it as point A. Ignoring the traded volume, the order block on the weekly chart, we already have a chain of 2 variables formed. This is a 4-hour rejection block within a daily rejection block, which increases the probability of our position working out. Now, we need to get a trigger on the X-1 time frame in the form of an FVG or a fractal. Moving to the hourly chart, we see that within our area of interest, a short FVG has formed, from which we need to get volume confirmation in the form of an order block or FVG on X-2, in our case, the 15-minute time frame. We obtained the order block zone, but it did not test our trigger, so I will not consider this a valid entry zone. In this case, we move back to the hourly time frame to find another trigger. We got a fractal high and now await its raid. On the 15-minute time frame, the price took liquidity from the hourly fractal and confirmed the volume with an FVG. Now, this is our entry point. Lastly, we need to get the target or our point B on the X time frame. Accordingly, this is the nearest fractal or FVG on the 4-hour chart. In our case, it's a fractal low. At this moment, we have a complete chain of variables that are synchronized with each other, and nothing prevents us from opening our position. The position performed excellently with a risk-to-reward ratio of 1 to 6. The second algorithm is called without trigger chain AB. It is similar to the classic chain, except that it lacks a trigger on X-2. Again, we get the background for our positions, which can be an order block, rejection block, fair value gap, or fractal point on the X time frame. After this, we get volume confirmation using one of our volume tools on X-1, and this zone becomes our new X point of interest or point A. The previous X is then noted as X plus 1. Again, we have two linked variables that increase the probability of our narrative. The next variable should be a trigger on X-1 in the form of a fractal point or FVG, but we do not get it. In this case, we need to get a shifted POI through volume confirmation to validate that the market is ready to move in our direction without a trigger. But this zone does not become the new X. It remains as X-1 because we have already received point A. From here, everything proceeds as in the classic chain. We look for a trigger in the form of a fractal point or FVG on X-2 within the new zone on X-1 that we received. The final step to enter a position is to get volume confirmation on X-3 in the form of an order block or fair value gap. Be very attentive here, since we did not get a trigger on X-1 but received volume confirmation, our point A does not change, and therefore our target, which is point B on the X time frame, also does not change. In other words, if X plus 1 background is 1 day, X POI or point A is 4 hours, X-1 volume confirmation is 1 hour, X-2 trigger is 15 minutes, and X-3 is 5 minutes, then the target or point B will also be on the X time frame, which is 4 hours. Let's look at an example on a real chart to understand better. In this case, the X plus 1 background for our position will be on the 4-hour time frame in the form of a bullish FVG. On the X time frame, we receive volume confirmation in the form of a 1-hour order block, indicating that buying volume has entered the market. This now becomes our main point of interest, which we mark as point A. Now, on X-1, following the classic chain, we need to get a trigger in the form of a fractal low or FVG. We receive this variable just before our zone is tested, and according to logic, the last thing left to do is to get volume confirmation in the form of an order block or FVG on X-2. However, the situation here is that when we switch to X-2, the price does not react at all to this trigger and does not form any volume confirmation. In such a case, we need to switch back to X-1, which in our case is the 15-minute time frame, to receive another volume confirmation. We get an order block zone, which validates our POI zone on the X time frame. After that, on X-2, the price forms a trigger in the form of a fractal low on the 5-minute time frame. The price reads this fractal, and on X-3, which is the 2-minute time frame, we receive volume confirmation in the form of an order block zone that also has an FVG inside. The last thing we need to identify is point B, our target on the X time frame. In our case, this will be the nearest fractal high on the 1-hour chart. We can enter the position because all variables are synchronized with each other, increasing the probability of a positive outcome. The position closed and take profit with a risk-to-reward ratio of 1 to 2.5. And the third and final algorithm you need to know to see more possibilities in the market is called fractal point chain AB. Here everything is slightly different from the beginning. On the high time frame, which is the background for our position, we need to get only one of the volume tools, order block, rejection block, or fair value gap. Note that here we do not have a fractal point. So, when we have one of the variables on the X time frame and then get a fractal point inside the initial zone on X-1 instead of volume confirmation, our X automatically becomes X plus 1, and X-1 simply becomes our POI X, which is now point A. At this point, we have two variables, The first is one of the volume tools on the X+1 time frame, and the second is a fractal point on X within X+1. The algorithm continues the same way as in the previous case. On X-1, we need to receive a RAID at the fractal point on the X time frame, followed by a shifted POI through volume confirmation, which demonstrates that volume has entered the market. Then, on X-2, we need to receive a trigger in the form of a fractal point or FVG inside or near the X-1 zone. Finally, on X-3, we need volume confirmation in the form of an order block or FVG to enter the position. So the last variable we need is our point B on the X time frame, which is the nearest fair value gap or fractal point. If the risk reward is favorable for us, we enter the position. Again, let's look at an example on a real chart. As an X+1 background for our position, we have formed a bearish fair value gap, FVG, on the 4-hour time frame. Now, to receive the fractal point chain AB, we need to find a fractal high on the X time frame. In this case, we have a fractal high on the 1-hour chart, which forms the 4-hour FVG. This will be our point of interest, and we mark it as point A. Next, we need to wait for a RAID on this fractal and get volume confirmation on X-1. The price aggressively takes out liquidity and forms a bearish FVG on the 15-minute chart, confirming that the market has received selling volume. Now we need to get a trigger on X-2 and volume confirmation on X-3 to enter the position. On X-2, we have a trigger in the form of a 5-minute FVG, after which the price forms X-3 volume confirmation on the 2-minute chart, from which we can enter the position. The last thing we need to identify is the target on the X time frame. We have equal lows on the 1-hour chart, so we mark them as point B. However, the position didn't work out, and we got stopped out. Indeed, it is very common in the market to encounter such situations where, theoretically, everything looks good, but the position still doesn't work. The problem here lies in two things. First, we need to remember the rule we discussed in previous videos, X time frame zones, such as point of interest, X time frame zone target, or trouble area. In our case, when we got the trigger on X-2 in the form of an FVG, at the same time, a counter zone also formed against us on X-2, also in the form of an FVG, which led to the stop loss. On X-1, the same situation occurred with a counter zone in the form of an FVG against our position. The second issue arises from the first and consists in the fact that the market has no problem making multiple liquidity sweeps to accumulate the necessary volume for price delivery. In such a case, the safest and most conservative stop loss would be placed after the strong high that took out liquidity on the X time frame. And the position looks like this. The price tests the trigger on X-2 in the form of an FVG, corrects into the counter FVG, then receives buying volume and reaches the fractal high. After that, on X-3, we get volume confirmation from which we enter the position, placing the stop loss after the strong high. On X-2, the price reads the fractal low, receives buying volume again, which leads to a raid on the fractal high, after which the market very aggressively reaches the target. The position closed and take profit with a risk-reward ratio of 1 to 2. Thank you for watching.